This video covers duration, dedicated bond portfolios, and immunization strategies. We're going to assume you have a basic understanding of duration that was covered in a previous video. So if you haven't seen that video or you don't understand duration, I recommend that you look at that material. This video will show the trade-off between reinvestment risk and price risk. We'll show that duration can be used to mitigate interest rate risk, describe the motivation for dedicated bond portfolios and how not to put together a dedicated bond portfolio, and then we'll show how to properly assemble a dedicated bond portfolio using duration. Recall that there's two types of interest rate risk. There's one, reinvestment risk, and two, there's price risk. Now let's look at reinvestment risk. Reinvestment risk is primarily associated with, look, you buy a bond at this point, a coupon bond at this point, and it matures somewhere out here in the future. Reinvestment risk is all about interest rates dropping. So if interest rates drop, you're going to have to reinvest all these coupons at low interest rates. And what's going to happen is you're going to have a future value that's accumulated here. All the cash flows rolled forward relative to the present value, the price that you paid. Right? It's going to be relatively low because these coupons are in low rates. And when you calculate the rate of return, the realized yield that you get from this, it's going to be lower than the yield to maturity. Okay? So that's reinvestment risk. If interest rates drop, this reinvestment risk is negative, right? And if interest rates go up as soon as you buy it, you're going to be able to earn a realized yield that's higher because your future value will be really high relative to the present value. You end up with a realized yield that's positive. That's greater than the yield to maturity. So reinvestment risk is negative, right? When rates fall. Now, what happens when interest rates fall in terms of price risk? Well, it's two things you got to look at. One is if you hold the bond to maturity, you have no price risk because it's going to mature at $1,000 no matter what happens. But if you sell the bond somewhere in between here, you have positive price risk. Price risk is positive, meaning it's actually a good thing, because what will happen is when the interest rates fall, right? So when rates fall, the price will go up. And so you're going to buy the bond. You buy the bond here, and as soon as you buy the bond, interest rates fall. Well, the price is going to go up. And if you sold the bond somewhere in here, you're going to get a higher price for the bond. You'll get a capital gain for the bond. So what you see here is this. If you hold the bond, say, for 1 day versus to maturity, and interest rates, let's assume rates fall. As soon as you buy the bond, rates fall. Right at this point, interest rates fall. Then you're going to have reinvestment risk that through maturity is going to be negative. And in a 1 day, if you just hold the bond for 1 day, like let's say this is your holding period, you hold the bond for 1 day versus to maturity, you're not going to have any reinvestment risk because you don't have any chance to reinvest the cash flows at that point. Now, in terms of price risk, you could have a substantial positive effect because as soon as you buy the bond, if interest rates drop here, the price of the bond will go up. So you could have a positive or a good impact on price. And if you hold the bond to maturity, it matures at $1,000 no matter what. So basically, there's no impact. Now, if interest rates go up, let me see if I can get this on. Let me do red here. So if interest rates go up, then if your holding period is 1 day, right, your reinvestment risk, again, you don't have any reinvestment risk because you're only holding the bond for a day versus, well, what happens if you hold the bond to maturity? Well, if interest rates are higher, we just said, look, it's got to be positive. And in terms of price risk, if we hold it to maturity, there is no price risk no matter what. And if interest rates go up, there's going to be negative price risk. So what you're seeing here, what you see here is that regardless of whether rates go up or down, right, there's going to be a negative versus a positive, or positive versus a negative, that somewhere in between the 1 day holding period and maturity, they're going to balance out to be zero. Because you're going to have positive at one point, negative here. The two are going to balance out so that eventually what's going to happen is you're going to get reinvestment risk will equal price risk. And when that happens, you have no interest rate risk and you've just immunized your portfolio. Now, how does this relate to duration? Well, what's really interesting is the fact that, remember, duration is measured in years. And it turns out that if you buy a bond with a specific duration and you use that bond to pay off a liability, in other words, dedicate that bond to pay off a liability, which I'll show you in a second, then if the duration of that bond that you're using matches the maturity of that liability, then you have no interest rate risk. You've immunized your portfolio against interest rate risk. So let me show you. So let me show you what a dedicated bond portfolio represents, and then we'll talk about the various ways you can dedicate a bond portfolio. So here you have a balance sheet. The classic example here is an insurance company, a life insurance company. Life insurance companies have liabilities. Those liabilities happen to do with when people die, they got to pay off the life insurance contracts. Well, a life insurance company on its liability side can project with actuarial help how many people in their portfolio, so to speak, are going to die and the value of those contracts that they're going to have to pay out. Actuaries are pretty good at doing that. And so every year going forward, they're going to have liabilities. So the insurance company is going to have a liability for next year that's due in 1 year. And they'll have liabilities that they can project 2 years from now, 3 years from now. Well, all the way into the future, 7 years from now, 20 years from now. And let's just say they have a liability. Let's just use one example to keep it clean. That they have $10 million that's going to be due in 7 years. That's what they project in terms of payoffs. What life insurance companies like to do is they like to dedicate a bond specifically, or a bond portfolio specifically, to pay off this $10 million. Now, there's various ways of buying this and assembling this bond portfolio to pay off this liability. And by the way, they would also do it. They'd set up a bond portfolio to pay off this liability, this liability, this liability. But let's just focus on the 7 year here. So now, how would you assemble a bond portfolio to do this? Keeping in mind that you want to have low interest rate risk, or if possible, no interest rate risk. Well, let's look at the scenarios that you can do. One is you can invest in corporate bonds, corporate coupon bonds that mature for $10 million. Oh, okay. So in 7 years, this corporate coupon bond, you buy a corporate coupon bond here that matures for $10 million in 7 years. Ooh, what's wrong with that? Well, you forgot about all the reinvestment of the coupons. That's kind of inefficient because you've ignored all those coupons that you've earned over the past 7 years, and that's a lot of money that you're not taking into consideration. You over-invested, in a sense, for this $10 million portfolio. Insurance companies want to do things efficiently, and basis points matter a lot for these companies. So you're kind of wasting. You're wasting all that reinvestment income, in a sense. I mean, it'll go somewhere into the company, but in terms of hedging and managing your portfolio efficiently, you've invested too much in these corporate bonds. The corporate bonds will earn a good yield, because they have some risk, and that risk will earn an extra return, but you've ignored the reinvestment component. Now, the second thing you could do is you could buy zeros. For example, U.S. Treasuries. Well, the problem with zeros are, from the U.S. Treasury, they're based on U.S. Treasuries, like strips, is that they earn low rates of return. Well, okay, so let's look at this now. You buy a zero here that matures for $10 million. And you say, wow, okay, wait a second. Now zeros have no reinvestment risk. So you buy this bond that matures in 7 years for $10 million. There's no reinvestment risk. There's no price risk because you're going to hold the bond to maturity and you know it's going to mature for $10 million. Ooh, that looks good. But again, the yields are going to be low on those things in general. There's no real risk premiums built in. You're not going to earn a very high rate of return. And also the market for these zeros is very competitive because they're in short supply. The third thing that you could do is you could buy a coupon bond, coupon corporate. And by the way, this was a coupon bond too here, just to be concise. You can buy a coupon corporate bond, right, that has a maturity that's different than 7 years. It'll have a longer maturity than that. But you'll buy this coupon corporate bond with a duration, to be specific, a modified duration of 7 years. And if you buy this corporate bond with a modified duration of 7 years, and at year 7 it's worth $10 million, you've mitigated and reduced substantially interest rate risk to the point where price risk will equal reinvestment risk. And so that's what we want to focus in on. We want to find bonds with durations of 7 years and buy just enough to pay $10 million off. That's really the goal here, because if we buy bonds with a modified duration of 7 years and they mature in $10 million, then you have no interest rate risk and you just dedicated this bond portfolio to pay off this specific liability. And insurance companies will do that with each and every liability they have. So now let's analyze this fact and let's show the fact that, look, we can find the bond, we can find bonds, and we can assemble a dedicated bond portfolio so we have no interest rate risk. We need to show that mathematically so we're comfortable with it, not just talk about it, but actually show it. So I'll show you through a detailed example. So I wrote down the details of the example here. A life insurance company has a $10 million liability due in 7 years, like we've been considering so far. And you're also considering the following bond. The coupon is 6%, pays semi-annually. It has maturity in 9 years. The yield to maturity is 7.85%. The face is 1,000. The duration is 7.22 years, which you could recompute yourself. And the modified duration is 7 years, which you could recompute yourself. How many bonds are needed to pay off the liability? Show that your answer is robust if interest rates change to 6%, 7.85%, or 9%. So what we're saying is, no matter how much interest rates vary within reason from the 7.85% benchmark right here, that we're going to still have enough money to pay off this liability. Now, keep in mind, before we go further, that the value of this bond is $882.18 as of today times 0. Let me move to another slide here and I'll graph out what I'm going to do and then I'll build a table. So, timeline. There's 9 years. Here is about 7 years. This is when $10 million is due. You're buying a bond for $882 here. And you need to buy enough bonds to pay off this $10 million here efficiently without interest rate risk. Okay, efficiently meaning, you're not going to have any money left over, so to speak, like, leftover coupons, or we're going to be short some money and so on. We want no interest rate risk, and we want it to mature for $10 million. So what we have to do is, I'm not going to draw this out and write this out in detail because it'll take me too long given they have all these periods. There's a total of 18 periods here. So what we need to do is we need to see that we have enough cash flow at this point in time. And the way we're going to do it is we're going to take these cash flows and we're going to compound them forward. All of these cash flows, compound them forward as of this date, 7 years from now. Okay, that's going to be a future value calculation. And then we're going to take the cash flows from here the $1,000 face for the bond, discount that back, and we're going to discount each one of these cash flows back to year 7. And what we hope is when we take this, use this bond, we're going to have we have enough, if we have the right number of bonds, we'll have $10 million right here at this point. That'll be interest rate risk free, so to speak. Let's do the math. We're going to run the scenarios. This is how it's going to work. 6%, 7.85%, and then 9%. So what we're going to assume here, what we're assuming here is, look, we buy the bond for $882.18. Question is, how many of them? And immediately after we buy the bond, like right here, immediately afterwards, interest rates drop from 7.85, they drop to 6% all the way through the next 7 years. Or as soon as that happens, right, rates go up to 9% for this period, or they remain the same. So you buy the bond, interest rates remain the same. So what we're saying is, no matter what happens to these interest rates, we're going to still have the same amount of money that we need, $10 million in year 7. So there's our scenarios. So let's look at those future values of the coupons. And the future value of the coupons, I'll give you basically how you put that in your calculator. We got to go forward 7 years. Okay, we got to go forward 7 years. So that's 14 semi-annual periods. The present value is 0 for those coupons. The payment will be $30 because we're looking at a coupon of 6%. Chopped in half because it's semi-annual. It's going to be $30 coupon every 6 months, and we're going to put I/Y, and I/Y will equal 6%, or it'll equal 7.85%, or 9%, depending on the scenario. And then we're going to compute future value. And when we do that, let's anchor here. Let's look at the anchor first, because that's where we're starting from. We're saying that interest rates remain unchanged at 7.85%. And this will be $545.94. Okay, so that's the amount here rolled forward. You'll have $545, almost $46 at this point. Now, what's the present value of these cash flows here? Because this is, because when you get to this point, you will have reinvested all these coupons, and then you're going to sell the bond. But what's the value of the bond? Right here, it's the present value of the cash flows. That's why we need to calculate this as a present value. So, present value of cash flows. N will equal 4 semi-annual periods here. I/Y will depend on what scenario, but for now it's 7.85%. There is a future value of $1,000 because that's what the bond here will mature at. And we will have a payment equal to $30, and we're going to compute present value. And we do that, this will be worth $966.36. Add it up, and you're going to come up to $1512.30. That's how much the cumulative cash flow from this bond will be from all these coupons and from the present value. So it's a future value and then the present value of the future cash flows. Now, if we've done things right, then what should happen is under the 9% scenario and the 6% scenario, we should have about $512. So that regardless of what happens, the cumulative cash flow balances out. There's no interest rate risk. So if we do this, we'll get $512.90 and we'll get $1,000. Which you didn't really have to do any math because the coupon bond is 6%. And then the yield to maturity here, the interest rate is 6%, then you know this is going to be $1,000 right at this point. This will be $512.90. Okay, pretty darn close. Continue here. This will be $567.96. And so this should increase as the interest rate goes up because you're reinvesting the coupons at higher rates. And this should be lower. So you kind of see that positive, negative contrast, that increase and decrease contrast. This is $946.18 because interest rates are high the value of this bond at this point will be low compared to these scenarios. And this comes out to be 514.14. Okay, so we're off by a dollar or two, but that's not bad at all. Now the question becomes, how many bonds do we need? Well, we're going to need, there's two different ways you can calculate this. We need $10 million right here. And what we're saying is we have all this cash, $1,512.30 approximately, regardless of the scenario here. So how many bonds does it take to that are valued at this in terms of year 7, given that you need 10 million? Well, that's not hard to calculate. That comes out to be 6,612 bonds will get us $10 million right here with no interest rate risk, because I'm showing you no interest rate risk. Now, the other way to calculate that, by the way, to verify, because you always want to verify you get, you have your math right. Lots of calculations here. Let's take $10 million in year 7 and discount it back at the yield to maturity. 785 divided by 2. And we're going to discount that back 14 semi-annual periods. That comes out to be 5,833,370. So what we're saying is, if you take the present value of this amount, compute the present value at this point, the present value of that liability is $5,833,370. Well, each bond is worth $882.18 right here, 882. That comes out to be 6,612 bonds are needed to get this situation under control, so we have no interest rate risk, provided interest rates don't change too much. And we've done it very efficiently with coupon bonds that have a decent yield.